All right, welcome back. Welcome back. This is just a continuation from what I started. So this is the part two of the tutorial set 5 solutions, suggested solutions. Yeah. So let me dive in. If still you have not liked, kindly like this video for me, okay? Kindly like this video and also subscribe to my channel if you are new to this channel. All right, so let's go. All right, um we completed question one. Let's move to question two. So question two is asking us, what is value of risk? So value of risk is actually simple. What it means is that it's like the value of risk measures the maximum loss that can be incurred over a specific period of time at a given level of confidence, right? So meaning that if you have, let's say, 99% confidence level in a particular trade, right? Then it means, and then your risk is around 10%. And it means that 99% of your trades, the loss that you are going to make will not exceed that 5%. So after 99%, that's when any trade after that can exceed that 5%. And that's when we bring in expected shortfall. So let me try and then see whether I can do a graphical representation of this. So let's just solve this, and then after that, um, I'll put it on the graph. So we have, then they are saying that Commonwealth Bank of Australia has reported a 99% value at risk of 2.5% over a 1268 trading days or trading period. What does this mean? So basically, what this means is that 99% of these trading days, which is going to be 99% of it, 99%, which is equivalent to 0.99 times 126. It's equivalent to 1255. So in 1255 days period, they are going to what? Make a normal loss, or their risk is going to be 2.85. So any days after that, right? Any days after the 1255, their losses can be more than the 2.85. That's what it basically means here, right? So the bank is unlikely to make a loss exceeding 2.5 in the first um, uh, in the first 1255 days. But after the 1255 days, they can make losses that is higher than the 2.85%. So let me put this here like this. So the confidence interval is normally drawn. So let's say we have 99% in here. Let's say between here. So here is going to be the 1255 days, or 1255 trading period. Right. So I'm just assuming that this is the 99%. So any days above any of this, right? Any days outside the 99% confidence level can, so here no, the rest is 2.885, right? So any day or any trading period after the 1255 days can have a loss that might be exceeding the 2.85% or below it. You get? So that's when we bring in expected shortfall. So expected shortfall normally measures the risk or the average risk after the value at risk, right? So here expected shortfall coming. Expected shortfall is going to measure the average of the risk or of the losses that you are going to make here, and then that is going to be what the expected shortfall. So that's the value at risk. So value at risk in here means that within the first 1255 trading days, you are going to, it is likely you are going to make a loss of 2.85. Like your risk is going to be, your risk in the first 1 to 5 days is going to be 2.85%. But after that, your losses can exceed 2.855. That's what it means. All right, so that's it for question 2. Let's go quickly to question 3. So question 3 is saying that consider the following realized annual returns. So 2013, 2014, right? So here, look at it. Here, they've computed everything for you. They've computed the returns for you already, right? So you don't need to recompute the returns, right? You can look at it straight and then what? Continue from there, right? So first, they are telling us to what? Estimate the average annual return on the stock bits and the stock arts, right? So remember, the average annual return is the arithmetic mean. So arithmetic mean, where we solve in the first one, and we said that you are going to add all the uh, you are going to add all the returns and then divide it by the n, right? Sum over n. So if you want to do for stock bits, then you add all the returns of stock bits, so 2.23.6 plus the rest. What is it? 23, 24 plus 7, 24.7 plus. So that's how you are going to do it. You are going to continue to the last one, then divide it by how many number of years? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So 10 years, so you divide by 10. That's for the stock bits. Then you do the same thing for the stock arts. So this one, you are going to get 8.82. Then you do the same thing also for stock arts. That one too, you are going to add all the returns to 46.3 plus 26.7, and then it is going to follow then divided by the 10. Then you are going to get 16.45, right? So the next part, so that's arithmetic return. The next part is what? To the estimate the standard deviation of the returns on the stock bit and then the stock at. Now, if you want to estimate the standard deviation, you take each of the returns minus the annual, estimated annual return, estimated average. So estimated average annual return. So you take the first one, like what we did in the previous video, right? So we is going to be equal to, and we take the first one, 23.6 minus its mean, which is 8.2. 8.82 all squared plus the next one, like that, 24.7 minus 8.82 all squared, and you continue like that. So continuing like that, then you do what? N minus 1, 10 minus 1 over 10 minus 1. So that is for stock bits. So after doing this, you are going to get variance. So now you get standard deviation by dividing it by the root sign, right? And this is similar to what we did the first one. So quickly, our advice, if you want to cross-check your answer, you just put everything on the calculator. So let's do this on the calculator again. So mode 3, by now they're on Saturn, so I can go fast too. So let's enter the figures for x, 23.6. 24.7, 30.5, oh, 30.5, 9, -2, -17.3, -24, 32.3, so here it is 46.3, 26.7, 86.9, 23.1, 0.2, -3.2, -27.0, with the same as -27, -27.9, -5.1, -11.3. Because this would take time if you have to do everything one in exams. So we are done entering them. AC shift 1. When we come to VAR, arithmetic mean for stock beats is what? 2. We had 8.82 for the annual average for annual average, the average annual return for stock beats. And then if you want to get for stock arts, shift 1, 4, and then we choose 5. Then that's it, 10.87. It's supposed to be 10.87 instead. We'll check the data. So this is supposed to be 10.87. Now, the standard deviation for this one, for example, let's see. Standard deviation for X4, 19.45. So then standard deviation for Y, going to be the same thing. So you take the first one, for example, 23.6 minus the mean, which is 10.87, all squared plus the second one, which is 24.7 minus 10.87, all squared, and then you follow like that. So it follows like that, and then divided by 10 minus 1. Now you're going to get the same thing. So now going down, down, down. Okay, in this question, they told us to compute standard deviation straight, so we don't need to even bring in variance part. So this is going to be shift 1, 4, standard deviation of Y is 7. So we get 35.64. It's 5.664%. Remember, the reason why we are using this percentage is because here was given to us in percentage. So if you want to bring it to decimal, divide them by 100, 100, 100, 100, 100, then you get it in decimal. But since it is given in percentage, I advise you continue with the percentages like that. You get it. Now, what is the next question asking us to do? So, which of the two investments would you recommend and why? So now, which of the two investments will you recommend, and then why will you recommend that investment? So the investments, we are going to look at them based on their expected annual return and also their standard deviation. So look at it here. The standard deviation of Y is 35%, which means the risk is 35.64%, 35.64%. And then the standard deviation for X is 19.45, which means the risk is 19.45%. Now, the expected annual return is going to be for A is what 8.82%, 8.82%, and then for B is going to be 10.87%, right? Or stock part is going to be 10.8% as the arithmetic return. Right. So it depends on the investor. So if the investor wants more risk, then the investor can take more risk and then uh, as in still invest in B because it brings up the highest annual return. But if an investor is somehow, if the investor doesn't really like higher risk like that, then what it means is that the investor is going to do what? Is going to choose the stock A, right? Because it offers the lesser risk, and then the annual return is relatively not bad as compared to this one, right? So we can additionally add, we can additionally calculate for the correlation coefficient, which is the standard deviation over the annual return. So when you find the COVID, or Merifisa from coming, the coefficient of variation. So we can calculate the coefficient of variation to find the risk to reward. So let's do the coefficient of variation. Coefficient of variation is equal to standard deviation all over the mean or the average. So when we take the first one, the mean is, the standard deviation is 19.45. All over the average is 8.8, is going to give us 2.20 192.21. Now, this is for X. When we do for Y, take the standard deviation to over. Okay, so the Y standard deviation is 35.64 all over. The mean is 10.87. It's going to be 0.2, let's say. So in the risk and return wise, we can say that asset Y has a better risk to return as compared to asset X. But this also would depend on the investor's risk tolerance. So if the investor is risk averse, then the investor will go in for the portfolio or for the asset that has lesser risk here, which is 19.45. But generally, asset Y is performing better because it has a better risk to return. So that should be you wouldn't really have to be specific on the kind of assets here, right? Because it will depend on the point of view of the investor, whether the investor likes more risk or doesn't like risk. So let's move to the next. All right, so let's move to the next one, which is question 5. You see the way the tutorial set is so bulk, it's packed. So me doing it fast, fast. So now this one is saying investor A has fund of 15,000. He has invested 5,000 in government of Ghana Treasury security. The other portion is invested in a risky asset. Assume that the expected return on the risk-free asset is 12%. The expected return on the risky asset is expected to be 30%, while the standard deviation is given as 15%. So what will be the return on this portfolio? So return on this portfolio, as we know, expected return is what? The weight of X times the return of X times the weight of Y times the return of Y. So the return expected return is going to be weight of X times return on X plus weight of Y times return of Y. Then this is going to be the weight. We have to compute the weight. If we want to get the weight of X, it's going to be, remember, the person have what? 15,000. And then let's attribute the weight of X to be the government bond. And then the weight of let's attribute X to be government treasury security. And then Y to be the risky assets, right? So I'm just attributing that. So X, the weight of X is going to be the 5,000 over the total amount, 15,000. And then we are going to get 0.33. Now, we getting this weight of Y is going to be the rest, which was to be left with 10,000 all over 15,000. And this is going to give us 0.67. So now weight of X is what? Weight of X is 0.33. So times the return on the government bond. So the portion, then assume the expected return on the risk-free assets, which is the government bond, is 12%. So 12%, 0.13 plus the weight of Y is 0.67 times the return on the risky one is going to be, the expected return from the risky asset is 30%. So 0.3, right? And then we are going to get a distance of 0.2406, which is equivalent to 24.06%. And that's the expected return on the portfolio, right? The next question is they're asking us, what about the risk of the portfolio? So risk of the portfolio basically means the standard deviation of the portfolio. Remember that they gave us the risk of only the risky assets, right? And then the government securities what is risk free. So now if we want to find the risk of this portfolio, what we are just going to do is we are going to multiply the weight times this particular standard deviation when we are done. So risk of the portfolio is going to be equal to the weight of the y, because that one is the risky one, times the standard deviation of y. Then we are going to get the weight to be 0.67 times the risk is what? The standard deviation is 0.15, right? And we are going to get a risk of approximately 10%. Approximately 10% here. Right, approximately 10%. Done with that one. We mean that with the expected return of 24%, we are risking what? 10%. So let's move on to question 6. Question 6. Hakuna Matata is thinking about investing your money. Whose money? Me, my money. Share. I mean, do I even have money? Sir, be more video in your money. Hakuna Matata is thinking about investing your money in the stock market. He has the following. He has the following stock. He has the following two stock in mind: stock A and stock B. He knows that the economy can either go in recession or it will boom. He also knows the following about the two stocks. So in boom, right? In boom, probability is for 0.6, and then in recession, probability is for 0.4. And then in terms of return, stock A is going to give us a return of 30% in boom, and then also 10% in recession. Stock B is going to give us 45% in boom and then 15% in recession, right? So now they are telling us to calculate the expected return for stock A and then for stock B. So basically, when you have probability in the mix, right, the way we compute for the expected return also changes. It's no more the weight of X times the way, because we have the probability here. The probability is more or less like replacing the weight. You get it? So it is going to be this way. It says calculate amount performed. So the expected return on A, right, is going to be equal to, why is my board stuck? It's going to be the probability of the boom session times its return plus the probability of uh the boom times its return plus the probability of what recession times its return. So 0.6 times 0.3 plus 0.4 times 0.1, right? Then in all, we are going to get approximately 0.2 or 22%, any of them. Now, the expected return in B is just going to be the same thing. It's just going to be the same thing, right? So it is going to be probability times the return plus probability times its return, which is going to give us approximately 0.33. Right. Let me just restart this board. White board is beginning to lag. All right, so we are done with computing expected return. Now, the next one is that we should compute the total risk, which is the variance and standard deviation for A and B. So risk, it says no more lagging. Oh. So we are doing it for stock A first, right? So first we do variance. So variance is basically we subtracting the returns from the expected return, then multiplying by the probability. So it is going to be the probability 0.6 for A, for example, 0.6 into brackets 0.3 minus 0.22 all squared plus the second one 0.4 into brackets and so wait. And with this, we are going to get 0.0096 as variance. Now, if we want the standard deviation, what we do is what? We put the variance in the root. So going to be the 0, and we are going to get 0.098, which is equivalent to 9.8%. That's it for A. That's it for A. And let's go to asset B. Variance is going to be 0.6 into bracket 0.45 minus 8% 0.3 squared plus. The second one is 0.4, which is the probability, and then 0.15 so squared. Now we are going to get a variance of 0.026. Our standard deviation is going to be the root of 0.06, which is going to give us 0.4, which is equivalent to 4.7%. Now let's look at C. C is saying that we should calculate the covariance, right? So this covariance here, we can't use calculator to do it because there's probability in the mix, right? We can't, as in, use the simple formula to do that calculator formula to do, or calculator trick to do, because we are in the midst of probability. So what we have to do is we have to now take the this one, so like what we did. So the probability of this, for example, this one. So we take this one and then this one. So 0.6 times 0.3 minus 0.22, but here we will not include the square, right? We'll take the square out. See? So the thing is C. So it is going to be the covariance AB is going to be 0.6 into bracket 0.3 minus 0.22, all multiplying by 0.45 minus 0.33. So this 0.6 is multiplying all of them. Then plus 0.4 into bracket 0.1 minus 0.22, all multiplying by 0.15 minus 0.33. With this one, we are not going to do any n minus 1 because there's probability in our mix. If there weren't to be any probability, like we divide it by n minus 1, right? So now it will be equal to 0.14. is equivalent to 1.44%. Right? So that's the covariance of A and B. And then now suppose Hakuna Matata is a risk lover. Which risk is a which stock will he invest in? So if he is a risk lover, let's look at the risk of the stock A and B. So standard deviation of stock B is 14.7%, which means it has 14.7% risk. And then for A is what, 9.8%, right? Let's look at the expected return also. Oh, the expected return is in that direction. It's in the other whiteboard. So the expected return for A was 0.22 and the expected return for B was 0.33. So checking here, risk lover, since he's a risk lover, he's going to invest in what? Asset B, because even though it's have a higher risk of 14.7%, its returns higher. Its return is higher as compared to asset A. So asset A return. So RA is equal to 0.22. Then the risk is equal to what was it? And then return on B is equal to 0.33, and then the rest is equal to 14.75 or 7. 14, let's say 14.7. Right. So since he's a risk lover, he's going to go for this particular asset because the risk is higher and also what gives higher return as compared to this one that has what the lower risk and then lower return as compared to this one. So you see here they are specifying that the person is what a risk lover. So if they don't specify, then you talk on the edges of both whether risk lover or risk averse, right? But if they say risk averse, then the person will go in for the smaller one. But if they say risk lover, going for the higher risk. So let's look at question 7. Question 7 talks about lower partial standard deviation. So this lower partial standard deviation basically only thinks about stocks that will have negative returns, that will have like that is risky. So they don't measure riskiness of an asset by its return, but like its positive returns, but by its negative returns. So now they are saying that with reference to the table, calculate the lower partial standard deviation. Why do some investors prefer to use lower partial standard deviation as compared to the standard deviation, right? That's what I've said. So if you are comparing an asset by its positive returns, if you are comparing the risk of an asset by its positive returns, then it is not risky, right? So if you really want to know the risk of an asset, according to the lower partial standard deviation people, right? You have to only consider a negative one. That is how risky the asset can be. So now let's compute a table. Let's open a table here. Question 7. And let's put in the same thing here. So we have the year, we have the holding period return, HPR for short. So 1, 2, 3, 4, then 5. Here is 10%. Here is 30. Here is negative 20. And here is 0. And then here is 20. So now, let's compute the arithmetic mean. So the arithmetic mean here is going to be equal to, so first let's compute the sum. So the sum here is what? 40. All right. So the sum here being 40, if you want the average or arithmetic, it is going to be equal to this divided by the 5 years, right? So you get a, oh, sorry, divided by 5 years. And then now it is what? 8. The arithmetic distance is 8. So the average return is what? 8. So any return that is above 8, right, doesn't qualify under the poor partial standard deviation. So now let's open the new distance, negative deviation. So now, what we are going to do now is we are going to compare this 8 to what we have in here. When we subtract uh, 10 minus 8, right, we are still going to get a positive return, which will be 2. So we don't look at that. So let me write a negative deviation is equal to HPR minus arithmetic return, or the mean, or the average. Any of them, right? So, so now, when we subtract the holding period return from this, we are going to get is equal to 8 and 10 minus 8. It's not risky, so we don't consider that one equal to 30 minus 8. It's still positive, so we don't consider that one equal to negative 20 minus 8. This is risky, so we take that one equal to 0 minus 8. This is also risky, so we take that one equal to 20 minus 8. It's positive, so we don't. So now what we are going to do is let's clear this one. The ones with positive, take them out because they are not needed in the lower partial standard deviation. We only look at the ones that has negative returns, right? So negative deviations. So now we square the deviations. We squared deviations. Yeah, squared is going to be equal to negative 28 times negative 7. Get 784 equal to negative 8 times 8. Get 64. So now we use the sum here again, right? So it is going to be equal to 784 plus 64. We are going to put this in the formula right now. So now if we want to get lower partial standard deviation, it's going to be root of what we just computed, which is 848 all over the number of holding periods. And the number of holding periods is 5 years. So all over 5 minus 1. So 5 minus 1, which is equivalent to 4. Now when we do this, we are going to get an answer of 10.8, 14.56%. We leave our answer in percentage because the question also gives the thing to us in percentages. So you also leave the answer in percentages. Right. So that is it here. And the reason why people investors normally use this is because this actually computes the actual riskiness of the asset by considering only the negative returns. Because positive returns doesn't show that an asset is risky, right? So that's it. So let's go to question 7, where we enter CAPM, business finance 2. All right, so question 7. Hey, is that question 7? Supposed to be question 8. Am I in question 7? So Luther Corporation has a beta of 1.45. The risk-free rate is 8%. So Luther Corporation has a beta of 1.45. The risk-free rate is 8%, and the expected return on the market portfolio is 19%. The company paid a dividend of 0.4 10 years ago, and the current dividend is 1.6. Now they're asking us, what is the stock's required return according to CAPM? So according to CAPM, remember that our R required return is equal to our risk-free plus the beta into brackets, the market risk minus the risk-free, right? So that's the same thing we are going to put in here. So in the question, we were told that uh, the stock required return, we were told that the beta is 1.45 and the risk-free is what, 8%. And the market risk is what, 19%. So you put the same thing there. The risk-free is 8% plus the beta is 1.45. Market risk is 19, and then the risk-free is 8, right? Then we are going to get R to be 23.95. Right. So that is the R. That is the R there. Now B is telling us find the growth rate of the firm dividend. So 10 years ago, the firm was paying 0.4, and then now the firm is paying what? 1.6. So remember, if we are calculating the dividend growth model, if dividend is growing, it is going to be D naught, it's going to be D naught equal to, so this is business finance too, a D1, sorry. D1 is equal to D naught times bracket 1 plus change. raised to the power n, right? And here we have what? D10, and then we have D10 is 1.6, and D0 is equal to 0.4. And then n is equal to what? 10. We don't know G, and then that's what we are coming to look for. We don't know G, and that's what we are coming to look for. So remember, if we want to get dividend at year 10, we can raise the power of the n up to 10, right? So now that's what we have here. So now let's compute for G. G will be equal to, for this one, if you want to do plenty calculations, that's your own listing. But me, as far as I have this here, calculator, come here. Now, remember, we are going to have D10. So D10, 1.6 is going to be the D naught 0.4 times 1 plus 10 raised to the power 10. Right? So now let's find G. So if we want to find G, what we are going to do is, let's go back. What you are going to do is 1.6 is equal to alpha half gets equal to 0.4 into bracket 1 plus, let's replace G by x. So alpha x, then bracket close, raised to the power 10. Press shift calc, then equal to solve for x. So this is x. X or G is going to be equal to, 14.87. Now, this same thing, you can also do this same thing by using another formula, right? Which is going to be price at the dividend at year 10. Or, so let me put, or dividend at year 10 over dividend at year 0, or raised to the power 1 over 10 minus 1. So let's put the same thing. Dividend at year 10 is 1.6. All over dividend at year 0 is 0.4. All raised to the power 1 over 10 minus 1. You can put this same thing on the calculator. One 0.6 over 0.4 raised to the power 1 over 10 minus 1. You get the same 14.17. So you can choose any of them. Now let's move to C. C is saying that what is the stock price assuming the required rate return, assuming this required rate and return in goods. Remember, the price of a stock is equal to dividend over R minus C, right? So dividend here currently is 1.6. R resolved was given to, resolved it to be 0.2 23.95. That was 23.95 minus the gene. We solve it to be 14.87. So in all, the price is going to be 17.6. That is the price of the share. But this is business finance too. Business finance too, yeah. So let's move to question 8. 8 is saying that if a preferred stock pays dividend of 0.5 forever, and investors have a required return of 15%, what will be the value of the stock? So value of a perpetuity stock, for example, a preferred stock is equal to just G over R. So dividend here is what's the G? 0.5 all over 0.15, which is equal to 0.33. That's 58. Hey, don't 58 for question. Let me use this as 59. Now let's move to question 10. Question 10 says that this is also business finance too, yeah. So question 10 says that Drobo Drug Limited has started the production of a new vaccine against a fatal sexually transmitted disease. Hey, the population of the product is such that the popularity of the product is such that it's expected to pay its shareholders dividend, which grows at 20% per year for the first 3 years, and after 3 years, most of the population would have been inoculated, and dividends are expected to grow at a steady 5% a year forever. The current annual dividend is 150, and investors' required rate of return is 15%. What should be the price of Robo Drug? Would you buy this stock if the current market price of Robo Drug is exchange on the exchange is 3,000? So this is basically a supernormal growth question if we enter back in business finance too. So if we want to get the price of a share today under the supernormal growth, it is going to be D1 over 1 plus R plus D2 over 1 plus R squared plus D3 over 1 plus R cubed. Then plus the price at when it began to what? Have a steady growth. So we have D3 plus 1 plus R. I know that PK, for example, PK will say this, not start saying, PK, the finance will be steady. Finance said it. So this is the formula, right? So now we have to find dividend in year 1, dividend in year 2, dividend in year 3, and dividend in when it started growing to calculate the price. So D1 is going to be 150 into bracket 1 plus the gene, right? The gene here is what? It is going to grow 20%, so 0.2. Then we are going to get 1, 8. Do the same thing, D2 is equal to D1, just 180. Or you can do the 150, then raise the power by 2, like that. Then D3, Now, you have to also find for D4. Because if you want to find the price of a share at P3, price of a share at year 3, or P3 is going to be D4 all over R minus G, right? So we have to find for D4. D4 is going to be the dividend in year 3, 259.2 into bracket 1 plus. Now you use the growth where it started becoming normal. So now you say to grow 5% forever. So this is the growth this thing that you're coming to use. Right? And you are going to get D4 is going to be 272.16. So 272.16. So now here it is going to be equal to 272.16 all over. The required rate is 15% minus the gene that we used to calculate it 0.05. We are going to get the price to be 2724.8. Right, so now let's bring it up here and put it here. So we had this SOP. Today it's going to be 180 over 1 plus R plus 216 over 1 plus the R again 0.15 squared plus the next one. D3 is going to be 259.2 over 1 plus R 0.15. Now we raise the power 3 plus the price at year 3 we had 2724.8 all over the same thing 1 plus 0.15, which is the half cube, same thing. Now this is going to let us get T0 equal to 2281.88. Now this is the intrinsic value that we are getting. And then this is what they are selling the price on the market. If it were be you, how will you feel? Will you buy? This is the intrinsic value, and this is what they are selling the shares for. Will you buy? I won't buy. The reason why I won't buy is because the stock is overpriced. Because this is what they are selling. This is if anchor, the stock would have been either equal to this or below. The one that they are selling is either equal to this or below this. Below this one that we computed. Like we would have purchased it. But as far as this is far higher than what we computed, we are not purchasing it. Now let's go to question 10 here. Question 10 here is talking about the value of it's talking about free cash flow, right? So free cash flow to equity basically is like the funds that are available to equity holders. after deducting all expenses or any amount that is deductible, right? So for us to calculate the free cash flow, we have to take into consideration all this, right? So net income is available. Depreciation expense is not a cash expense, so we add it back. Capital expenditure, we subtract. Change in net working capital, we subtract. And then principal repayment to we subtract. And then new debt issue, we've issued debt, so we are going to receive money. We add back, right? So what we just did was first in terms. So we are going to start with the next question. Here it is showing 10, but I think so far the question that should be answering, this should be around 12. This should be around question 12. Let's see question 12. So it will be net income then we add any full depreciation, for example, it's non-cash expense. So we add it back. And then we add the new debt issues back. Add it back. 40. So gross FCFE. Very good. Now we less capital expenditure. $80,000. We also less change in working capital. Then then we also less principal payments of debt. Principal debt repayment. Maybe likely that this person like this can drop because it wasn't previously in the tutorials set, but they've just brought it in, so it's a bit risky. The next FCF, going to be equal to this. Okay, principal repayment is 30,000. Sorry. All right. The next steps here is this. Now, said we should calculate if we should calculate the value of the equity. So the value of the equity is basically the normal discount value of is equal to FCF, the one that we have all over. Said it's R minus 2. So when we calculated, we had 16, 160,000, 160,000 all over. R is 0.15 and G is 0.06. We are going to get divided by, let's get 1, that's going to be the value of the free cash flow. So now question 11, here is question 11 that goes around question 10. What does skewness tell investors? And why would the standard deviation not be a good measure of risk when returns are negatively skewed? So returns being negatively skewed is basically trying to portray that the normal distribution is actually underestimating returns. So I'm coming, let me see if I can get a graphical representation here. So basically, Ankasa, the main lesson is that the skewness tells investors how the standard deviation overestimates or underestimates risk. But if the returns are negatively skewed, it means that the normal deviation has underestimated the risk taken by investors. And consequently, there are likely to be more losses than the normal distribution. So skewness in a previous lecture, I even explained it there. Then the normal distribution can be like this. Now skewness will come in and then it will let it be negatively skewed. So negatively skewed looks like this. Right. So this is the actual risk that was there. Then now there is the new risk. So you can see that it has been underestimated. This one might be, let's say, 10. Then this one will be like, let's say, 15 or so. You can see that negatively skewed will mean that the normal risk here, right, has underestimated the actual risk that the person is going to take, right? So that's what it means here. So the normal risk has underestimated the actual risk when it is negatively skewed. And when it is positively skewed, then it means that the normal risk, so positively skewed, will look like this. Will come to this side, right? Will come to this side. So you see that, let's say here is around, let's say 5. Here is around 5. And then it means that the normal distribution being 10 has what overestimated the actual risk, because if it is negative, then it means that the risk that the investor is taking is 5, but the normal distribution this thing has overestimated it to be 10. Do you get it? So that's what it means. So this is positively skewed. Positively skewed. Right? So basically, that's what I just said. So the skewness. So basically the first answer to the first thing is that skewness tells uh how the standard deviation has overestimated or underestimated risk. So why would the standard deviation not be a good measure of risk when returns are negatively skewed? So it is because it has underestimated the risk. Right. So that is it for that one. So we are being asked of what does ketosis tell investors? So ketosis tells investors about the likelihood of extreme values on either side of the mean. So for a series that exhibits fat tail, there will be more losses and gains than the normal distribution suggests. So ketosis media, it's ketosis no, it talks about how fat the distance is, or how uh, not fat it is. So if it is fat, then it means that it is going to cover almost all the losses. But if it is not fat, then it means some of the losses will come out, right? So what are the risk implications of an investor for a return series that's extended? So that's what I've just said, that for a series that exhibits fat tails, there will be there will be more losses and gains than the normal distribution suggests, because it is fat. You get it? So you can watch more videos on YouTube. You can be watching more videos to get more understanding. And it is also interesting. Time is going. So here, they say we should briefly explain the following concepts in investment. So we have black swans. So black swans are extremely low in probability and high in impact. So they don't normally happen, but when they happen, it is killer, right? It is very, 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 they have a very high impact. It is a risk in which it is a risk in which its likelihood is low, but when it occurs, its impact is very high. Then white swans is also, these are risks whose likelihood of occurrence is frequent and its impact is reasonable, but can be prevented from happening. And then the gray swans. This is a type of risk whose impact is extreme, but it can be prevented and known. So you see, its impact it looks like the black swans, but here it can be prevented, right? But this one, it cannot be prevented, and we don't even know when it will happen. So D, uh, gray, green swans. So green swans refers to an environmental catastrophe attributed to climate change. So it is a large-scale, high-impact event connected with global warming and impacts of pollution. And it will trigger a systematic financial crisis with implication, right? And normally, green swans are risks that are created by human behavior. That's like our behavior. And then we also have black elephants. This is a risk that is visible to everyone, yet no one wants to acknowledge. Then we also have gray rhino. A gray rhino is a highly obvious yet ignored threat. Now, let's look at the last question here. Explain the concept of expected shortfall and why it's important in investment decision. So expected shortfalls is the expected cost or is the expected loss conditional on the loss that exceed the value at risk. So if you remember, in the beginning of this video, I explained value at risk, and then I said that above the value at risk, that's where the expected shortfall comes in, right? So uh, it's it it is the expected loss at the worst case scenario, and it can help investors to plan ahead to cater for any extreme loss. Thus, it is the average loss after the value of risk. So, and it can also be called expected tail loss. So that's what I just explained here. So in the beginning, I explained that the value of risk is within the confidence interval, let's say 90%. This is where the value of risk is. The value at risk, sorry. The value at risk, right? So anything that is outside the value at risk or after the value at risk is where the expected shortfall comes in. So it is the value or it is the average of the losses that will be incurred after the tail. So that's why we can call it expected tail loss, right? So for example, when we use the 1, 2, 6, 8 days, and then the value at risk was 1, 2, 5, 5. The difference, right, will be the expected shortfall, this thing that we are going to look at. So if let's say in that difference, let me see, 1, 2, 6, 8 minus 1, 2, 5, 5 is 13. So the losses that you made after the 13, if let's say it was some figures B, you add all of them, then you divide it by the 13, then you get what your expected shortfall. So is the average losses that is or the average risk or the average losses, any of them, that is get like is expected after the value at risk, right? So that is it. And I think this is okay. This is it for this session. And if I get time, I'll do a recording on the last year past question. If I don't get time to, I wish you all the best and see you at the top. Bye. Don't forget to like this video and also subscribe to the channel for more. Because next semester, we are going to do more. All right. Bye.